I typically don't like to see people sitting on the back row, but I'm going to make an exception for today. There's plenty of seats. You need to be in groups of 2 for an exercise. Feel free to interrupt me. I give this one lecture in a pharmacy. What's the name of the pharmacy manager? Yeah. This is the best lecture of the course. You can tell Dr. Moultrie I said that. It's okay. We have till 5 o'clock, right?
No.
3 to 5?
No. 4:20.
We'll see what we can do. If you go past 5:30, we'll just order some pizza.
Yay! I don't eat pizza.
You all know my sense of humor, right? I don't do a lot of monologue lecture. I'll talk to you, so the sooner you talk back, and I want everybody to talk, not just a few of you. You're not going to be accountants or financial folks, but you need to have a sense of financial reports and pharmacy practice. That's why we give this lecture. Is this book one of the required or recommended books in this course? Or
Yes.
not? Pharmacy Management by David Zegeric.
Yes.
It is recommended. So this is the book. So I'm using, the slides come from one chapter in this book. In case you find it electronically on Access Pharmacy, is chapter 21. So the material and the slides, the content is chapter 21 of Pharmacy Management, 5th edition by Zegeric. The chapter was written by the Dean of College of Pharmacy Health Sciences at Texas Southern University. Do you know who that is? The current dean. Oh. That's where this stuff comes from. Chapter 21 is written by the Dean of the current Dean of College of Pharmacy Health Sciences at TSU.
Whoa.
You can read it if you want. The reason this is important is because you have to have a sense of what is happening around you when you practice pharmacy. You all hear me in the back? You're supposed to say what? That's it. Okay, you hear me seriously, right?
Yes.
All right. There are 2 types of practices where these financial reports are very different from one another. By the way, I sent Dr. Moultrie 6 or 7 easy multiple choice true false questions for some exam or whatever. Yes?
No, we don't have the slides.
What?
We don't have
I know you don't. I'll post it later.
Says he gives it back.
I'll post it afterwards.
You didn't even ask.
Yeah. That's why I want you to pay attention to here and to me, not so much looking at your slides. So, in community pharmacy, the financial reports are very different than in hospital practice. Keep that in mind. Community pharmacies are called cost centers. I'm sorry, profit centers. Community pharmacies are profit centers. Why? Because they are supposed to make a profit. So when you go to a Walgreens store, the Walgreens store at the corner of whatever, what is it, Happy and Healthy or whatever they say? What does the commercial say? Happy and Healthy? Whatever. A Walgreens store is a profit center, so they use different reports than your hospital pharmacy when they're doing IVs and medication orders. They're called a cost center. They don't bill anybody. Anybody works in a hospital? You don't do any billing. You just go there, make the IVs, make the medication orders because they work from a budget that comes from the main hospital. So those are cost centers. There's a good chance that I ask you a question on the exam of the difference between a profit center and a cost center. Again, remember, interrupt me anytime. When we talk financial reports and everything you do in your life, it divides up into investing and financing. Okay? Investment is a car. That's an investment. If you have a car, it's an investment. This water bottle over here, that's yours, right? That's an investment because it does something for him. It has a benefit to him. A car has a benefit. Anything that is invested has to be financed. There is no other way around it. He paid for this somehow. You paid for your car somehow. Either it was your own money or you borrowed the money. Short of stealing anything, unless you stole it, you have to finance it. There is no other option. You with me so far? Anytime I lose you, just raise your hand and say, I'm sorry, I don't follow. Okay? So far we're okay, right? All right. You probably have seen this in undergraduate years if you took economics, where it says assets equal liabilities and shareholder equity. That equation holds every single time. It holds at Walgreens, it holds at TSU College of Pharmacy Health Sciences, and I give you plenty of examples, so don't, if you're a little confused right now, just hang in. The assets that you have to always equal your liabilities, and shareholder equity simply means your money. It's your money that you have. So I'm going to give you enough examples so that you get a sense of what is it are we talking about. Examples of assets are things and stuff that you have. Cash is an asset. Inventory in your pharmacy is an asset. Building is an asset. What is a liability? It is the money you owe to everybody else. Like you borrow money from your parents. He borrowed money from his parents to buy this water. I'm going to give a lot today. So if he borrowed money from his parents to buy this, it is his asset for $5. How much did you pay for that? A lot more than $5. $20. So he has an asset worth $20, right? Liabilities are, he borrowed $10 from his parents, right here. The other $10 was his own money. The asset that is you invest in, always, its value equals the liabilities, if you owe somebody some money, and shareholders equity. If he had the $20 to begin with, obviously he would not have any liabilities, it would just have 20 equals 20. Clear?
No.
Where are you? Who said no? Okay. So if you have a car, right?
Yes, sir.
So pick a number. How much did you pay for the car?
Nothing.
Nothing. How did you pay nothing for the car?
I've paid it off.
Huh?
I don't owe anything.
Just hypothetical.
It's a hypothetical question. You have a
Just
car.
give a number.
You have a car. Do you not have a car?
I do.
Okay. How much do you think is the car?
40.
$40,000.
Okay.
That's your asset. Because it does something for you. It's your car. It takes you from point A to point B. The next question you have to ask yourself is, how did you pay for that $40,000 car? Did you write a check from your savings account?
Borrow. You borrowed.
How did you pay for it?
You took a loan, right?
Can you check?
Okay, check.
You wrote a check for $40,000.
So you didn't
Am I
borrow.
correct?
Yeah.
Okay. So your asset for $40,000, which is your car, equals to your money of $40,000, and you owe nobody no money because you had the money.
Okay.
Follow me?
Yeah.
So the importance of this equation, whether you are the owner of United Airlines with 750 jet planes, or you're a small college of pharmacy at TSU, when you do accounting, all of your assets have to, there is no other option, otherwise somebody's stealing money somewhere. All your assets have to equal what you owe and what you have. Again, example of a car. If she paid $40,000, her asset is $40,000. She didn't borrow anything from anybody. She paid $40,000. Sometimes you pay $20,000 to the car dealer, and you go borrow the other $20,000 from the bank, so 20 equals 40. I have everybody with me so far? Yes. All right. So this is what you have here is three important financial statements that we're going to talk about today. Your balance sheet, income statement, and statement of cash flows. I'm only going to talk about two. I'm only going to talk about and help you understand the balance sheet and income statement, and not worry about the statement of cash flows, because this is not a class in business school. It's in pharmacy. All right. This is strictly from the chapter. It's an older figure. What are we talking about? I just told you the main types of financial statements. Balance sheet, income statement. Let's focus just on those two. Don't worry about cash flows. All right? Balance sheet definition is a snapshot of firm's investment at a given time. How much money is in the company right now? And I'm going to give you again examples. What are the assets? What are the liabilities? What's our own money? Snapshot. We do this every year. Every 90 days. Every 30 days. Think of it as a photograph. Right? Income statement is, okay, how much did we sell today? How much money do we owe today? What is the cost of the medications we sold? That's all in the income statement. Income statement is like a video. It's not a snapshot. But the income statement connects the beginning and the end of the balance sheet. So I have a balance sheet for year one, which I want to show you in a minute. This is how many assets and liabilities we have. We do all sorts of videos of income statements, selling drugs, filling prescriptions. We come to year two, and that income statement is going to connect the first balance sheet to the last balance sheet. Are you okay so far? Again, I'll give you examples. So if it's a little confusing, just hang in there. But do remember, what balance sheet does is, it's going to show us assets, liabilities, owner's equity. All right. Now, what we're going to do is we are going to take one and pass it to the back. And if there's extras, I will take it. Take one and pass to the back. Let's got a hand up. Okay, here's the plan. The plan is you are going to operate a lemonade stand, and we're going to do a balance sheet together. You have $5 of your own money. You borrow $10 from your mom and dad. Clear so far?
Yep.
All right. So, what do we actually have before we start operations?
Yeah.
We have cash of $15. That's our assets. Remember I told you cash is an asset. Who owns the $15? There is this thing called notes payable. You owe the note to your parents. I owe you $10. So that's $10 to the parents. The original investment was $5, totals $15. See, they match. The $15 that we have on hand matches who owns the money. Okay, we haven't started the lemonade stand yet, but we are going to complete at the beginning of our business, day one. We're going to fill out a balance sheet. What do we got? Fill it out. You got 20 seconds. You fill out this balance sheet that is in front of you. The lemonade stand business, day 0. We have not gone to the operations. Go ahead and put numbers down. It should be very straightforward. You know all the numbers. Work together. Don't work together. Work together is better.
So the assets is what we have, which is cash. That's 15, okay? So it's 15. Total assets is 15. Liabilities, no payables are $10 because my mom and dad borrowed 10. My original investment was $5. My total was 15.
I need a group of you to tell me what are the assets in this business.
The total amount you have, 15.
$15 here. Cash is 15. It's your only asset. You might have assets later. But for now, you got $15 cash. Cash is an asset. By definition, assets bring more money. Liabilities don't. It's money you owe. Total assets is how much? $15. What are your liabilities? You have a note payable to parents for $10. What is your shareholder equity?
$5.
That's your own money. Total?
15.
So your assets, once again, equal your liabilities and your shareholder equity. There is no other option. The equation always holds. All right. So, we already talked about this. A balance sheet is a scorecard. It's a snapshot in time. And it's an image of your financial position. Where are you today in December of 2023 as United Airlines? What are your assets? What are your liabilities? Everybody with me? All right. Let's move on. So what you got now is you're ready to operate, aren't you? So this is what you did. You went and bought 50 lemons for $10. You bought 5 pounds of sugar at 40 cents a pound for $2. Total purchase of $12. One thing you need to calculate always is as follows. This stuff that you bought is enough to make 60 glasses of lemonade. So it's $12. $12 over 60 glasses. Your cost is 20 cents a glass. If you don't know your cost, you're finished. Because you don't know how to price a product. If you don't know how much something costs you and you're in pharmacy business, then you don't know what you're doing. If you're selling 90 lisinoprils for a 90-day supply, and you don't know how much that lisinopril is costing you, then you don't know what you're doing. $12 you spent is good for inventory of 60 glasses of lemonade. Your cost per unit is 20 cents. Everybody follows?
Yes.
All right. So, go ahead. Create a new balance sheet based on the fact that you just spent $12. You haven't started the business yet, but you went and spent some money. So now remember, most companies do balance sheets every 90 days or a year. You're in the lemonade business, you're a child. You're doing it every day. So now you are going to, you have 30 seconds to create a new balance sheet based on the information given. Based on the previous slide, you need to fill that out. Work together.
You had $50, right? And then you
The note payable was $10, right? And the owner's equity of the original
you
investment
had $3.
is
Then inventory.
the liabilities plus the owner.
Cash inventory.
Is it still not 15? Is it still not 15? Okay, so wait. Okay, it's based on this. So what I said was you had a total of $15 cash, but then you invested 12, which leaves us with total assets of 3.
So you have
Right? Because 15 minus 10 is 3. Then
the total assets
liability
is $3, right?
Is there a group that is finished?
it's not 10 anymore.
What?
From what I borrowed from my
Raise
parents.
your hand. Who's done?
So liability.
You're done. You're done. You're done. Okay. These two groups over here done. How much? You're done. How much cash do I have? I have $3 cash. Did everybody get $3?
Yes.
How come I have $3?
Because you spent 12.
Because I spent 12 getting the sugars and the lemons. So cash
Okay, so
is
then
$3.
payable, maybe
What is my inventory?
12.
$12. Because I have the inventory. I have the lemon, I have the sugar. I'm ready to go. So I took my initial assets of 15 cash to a $3 of cash remaining, $12 of inventory.
It should still be 10.
What are my liabilities? $10.
It's still $10. Because you owe that to your
You owe it to your parents, so your liabilities didn't change. It's $10. What is the shareholder's equity?
5.
Your own money of 5.
So your total is still 15.
It's 15.
Oh, so he from
Add up to
what
your total assets.
Well, how did he? Okay,
Let me
so
know
the
if you're
3,
confused.
and this
It
is
should be 15.
So this is 15.
Right. Okay.
why not inventory is 3
Alright.
and the total?
Yes.
No, look at it. It's 15, 12. Isn't that what he
So the liabilities of 10 added to owner's equity of 5 gives you 15. 15 matches 15.
So your cash you started off with 15.
I want to ask you on the
But you
exam.
invested 12. And then your total now is 3.
Alright, let's go. We're going to price this number at 50 cents. Pay attention. 50 cents is the price.
15, 12,
You sold 50 glasses.
3, 12.
You priced it at 50 cents and you sold 50 glasses. What is the total sales for the day? What is it paying you? $25? You sold 50 glasses at 50 cents.
I'm confused.
Sales is $25. Cost of goods sold. That's a term that you hear in pharmacy practice a lot. Cost of goods sold. How much is the cost of goods sold, ladies and gentlemen? I hear it 12 over here. Do I hear anything else? How many glasses did you sell? 50. What was the cost per unit?
20.
20. What is 50 times 20?
6.
$10. Not 12. 10. Cost of goods sold. Go back 3 or 4 slides. We decided that because your inventory makes 60 glasses, the cost per glass is 20 cents. If you sold 50 of them, it's 50 times 20. Everybody's with me, or have I lost something?
Yeah, you lost.
If you go back a couple of slides, let's actually go back a couple of slides. Right here. You remember this slide? What did it say? The cost to you to make a glass is 20 cents. You forgot about this 20 cents here. So when you go forward to here, the cost of, you sold only 50. If your cost is 20 cents per glass, 50 times 20 is $10. So your sales are 25. Your cost of goods sold is 10. Then there is this beautiful thing that everybody loves. It's called gross margin or gross profit. What is your gross profit? 15. You sold $25 worth of stuff. It only cost you $10. You're about to pocket $15. That's like a little income statement. Right? We made 50 glasses of lemonade, sold them. Our cost was 20 cents a piece. That's $10. We sold it for 50 cents. We have $25 cash in our hand. Right? And what's our margin again? Gross margin? 50.
You did 25 minus. Which got you.
Gross profit, not gross margin, I'm sorry. Gross profit by definition is your profit before you pay your bills, before you pay your salary, before you pay for the electricity, right? It's gross profit. Net profit is after you pay everything, including yourself and your taxes. If there's anything left, that's net profit goes to the bank.
Yeah,
If you want, goes to your pocket. If you don't. Everybody's with me so far. So we went into operations. We had a previous balance sheet. We went to operations, sold stuff that cost us money. We have a gross profit, and guess what? Make a new balance sheet based on the information given. You just had some incomes. 30 seconds. Now you make a balance sheet of the state of this
Sold 50
company
glasses.
after you have
Times
sold
$0.50.
$25 worth of stuff. I give you 60 seconds.
Right. 50 glasses times 50 cents is $25.
Oh, okay.
So now Our gross profit is $15. We invested 12.
0.5. It just says 0.5. So I don't know why. So 0.5 times 50,000.
So what is our total assets? Does it come back to me?
You told me to do 0.5.
Oh, it's 15 plus the 3. So 15 plus 3, is that not 18? Is it not 18? Because the cash we got as our earnings is $15, right? But originally we were left with $3, right?
Yeah, originally we were left with $3. That's
And we invested 12. So this 15 plus
Got about 30 seconds.
18.
and then 12 is what we invested. And so isn't our total assets 18? Because that's 3 plus 15. That was the 3 remaining balance. Then your notes payable is still your $10 for your parents. And then the original investment is $5. And then the total earnings for the period is the 15. Plus the 3, right? Would that be 18? Or is it just 15? That's what I'm trying to figure out. Because you earned 15 as a profit, but you had 3 remaining.
remaining before. So you added to that 3 is 16.
That's how I got 18 for total assets. Then my notes is what I owe my company. That my original investment is 5. So earnings for the total. So liability. So it says liability plus owner. It's still 15. Is it not just 15?
Any group finish?
But by the middle, the
Not yet? Let's see how much time. You have.
this is 15. So, okay, that's what we started.
That's what I feel like, but I don't know. Because originally the cash
Are you
you
renting
made.
with your parents?
No, thanks. Because remember, the cash is the fact that I earned $15,
You done?
but I had 3.
You're done. Okay, hold on. You guys are done, you two? You're done. Okay, you ready? How much cash do I have? $28. Because I sold 25 and I had $3 left over. Because remember when I had 15, I went to the store and I spent $12 and bought the stuff. I had $3. Then I made the lemonade and then I went over there and sold it. So the total cash on my table is $28. That's cash as an asset.
I don't see that.
What is my inventory like? Why is my inventory $2? Speak up. Because I made 60 glasses and I sold 50 glasses. And each glass cost me 20 cents. So I have 10 glasses left over in the fridge. That's 10 times 20 is $2. I still have some left. I have $28 of cash. $3 from before I went to the store. Remember, I had started at
So
15.
it's 20. So
Follow me.
26.
It's not that difficult. It's very rudimentary until I show you some more complicated stuff.
Okay, so
So
26.
I have $3 from before I went, after I went to the store. I made this stuff. I have an inventory of 10 glasses left in the fridge, and the unit cost of 20 cents per glass. That's $2. And I have 28 in my hand. Because 3 from before, $25. You just told me you sold $25 worth of stuff. What is my total assets? Obviously 30. 28 plus 2 is 30. So once you get through the assets and it's logical, then you follow the rest. What are my liabilities? Who do I owe money to? Parents. So my liabilities haven't changed. It's $10. So that's $10. What is my shareholders' equity? Shareholders' equity. Original investment is what? $5. My own money. My own money.
So if
Earnings per period. For the period. How much money did I earn? 15. Because I sold 25, but the cost of goods sold was 10. Remember that? So the earnings for the period is 15. Add them all up. 30. And 10 and the 5 and the 15 is 30. I have $28 in cash. You're waiting on that one. Inventory in the refrigerator is $2.
I didn't catch this. You don't realize this.
Liabilities didn't change. Owner's equity didn't change.
So So
You are having only two.
I sold $25 worth of stuff, right? 50 times
no,
50 cents. But
Yeah,
the cost to
jumped.
me
Okay, you jumped.
yeah,
was 50
So
glasses
this is-
times 20 cents. That
okay,
was
this
$10.
yeah, it's
The earnings were 15. That's what it says. Put down your earnings. Add them all up. Adds up to 30%. If you can't add them
So
up,
this one,
which means if your assets don't equal liabilities plus owner's equity,
this
and
one
notice
is 10.
owner's equity has new
10
categories.
plus.
Assets have new categories. The oldest was just cash, but inventory is an asset, right?
Damn.
And also earnings from the period
10 plus
is
5 plus
also part of your
Yeah,
equity,
yeah,
part of your
so
money. So
the
you're
5
adding
was the money
new
we had, I
categories.
had. The 15 was.
I'm hoping you're all with me.
The 15
All
was.
right. I have some bad news.
it gets harder.
So the bad news is, that's not on your slide, that you're gonna need to add that. The bad news I have to share with you
The-
folks
Yeah.
is that you have some expenses you forgot about.
Of course.
You did operations, you sold 50 glasses, you have 10 glasses left in the fridge, but your parents came to you and said, listen, the glass rental is $2. So put a 2 right here for the glass rental you borrowed from your parents. And you know that little sign you made to put it on the front yard? That's advertising, that's $1. So we got $2 glass rental, $1 advertising, and also you have some rent because you rented the table with the summer. That's $2. 2, 1, 2, total expenses are $5. You now have expenses, and guess what? You paid the expenses. That's important. The parents came to you. How much money is in your hand, by the way?
30.
No, 28 cash. The other 2 is inventory
Oh,
in the
that's
fridge.
right, we just got it.
Your cash is, you're following me, I'm happy. You guys are your faces all smiling for years. You're like, why do I have to learn this? I thought all I have to do is take CODA classes, pharmacotherapy classes, Dr. 70, and whatever. And now you confuse me with this nonsense. Trust me, this is important. There's another thing that's important, more important than this. $5 of expenses you paid already. The parents said, I want my money right now. You with me? Yeah. Okay, you filled out your previous balance sheet, right? So the previous balance sheet, I hope you all have the numbers here. Because we can't go forward if you skip. So remember how you had $28 of cash, $2 of inventory, right? You fill that out. 28, 2, so on and so forth. So, the bad news was you had $5 of expenses you already paid. You just paid them. Make a new balance sheet. 60 seconds. You just paid expenses. Issue another balance sheet after you paid your expenses.
Okay,
Yeah, but this.
the cash that we had originally was 28, right?
Yes,
So
but
that's
revenue
$28.
one.
Inventory is still.
And then, yeah, so
That's $2.
inventory,
So total assets
$2, but we have to now pay $2 for rent, glass rent.
You still owe $10.
It's a lot easier than
Do
you
we
think.
say 28 minus 5? Do we say 28 minus 5? Because if you know this,
No.
right, but you're looking at the assets you have on hand. We have 28, right? But we paid for glass purchase.
Okay, the one that we rented.
Glass purchase was $2 in advertising, and $2 rent was $2.
Which is
So that's
$5.
28 minus 5.
Earning
Or is it still 28?
Yeah, the same. Okay, when we were paying for it, yes. I think so.
Okay, well then inventory, we invested $5. Would you say inventory, we invested $5? Because we had to pay all those expenses.
No, it's actually how
No,
much
if
have
we
you
should pay,
earned.
if we should pay the
No,
whole
how much
expense,
you
when we invested,
So it'll probably be 20.
Ready? You pay your parents the $5 you owe them as expenses. You're creating a new balance sheet. How much cash do we have?
Oh, this is $5 right here.
$23 because you did.
$23.
Let's not send it now.
Say that's $23 cash.
That's
What
it.
else your inventory? Two. You didn't do anything to it. It's still sitting in the refrigerator. Two. What does that mean? Your assets dropped by $5, right? Because 23 plus 2 is 25.
So our total
So now your total assets in the company just went down by 5.
25.
You have 25. What happens to your liabilities?
It drops.
Still the same. You owe $10.
It's still the same.
Right?
Yeah.
What happens? Okay, now we go under owner's equity.
No, we don't need to, we'll take out
$5.
It's
Earnings
$5.
for the period.
So
20,
It
30.
used to be 15, but you lost 5.
So it's 10.
Remember the previous period earning was 15 because you had not paid your expenses. Like when you're in a real pharmacy like
So
Walgreens,
it's $25
if you don't pay your
total.
taxes, your earning for that period is higher till you pay $10,000 of taxes. Or whatever. So your earnings per period is down to 10. You have $25 of assets. You have 10 plus 15 is 25. Once again, the equation holds. How many of you have a loss? Yeah.
What did
Go
y'all
ahead.
y'all got?
Hold on.
5, 10,
I need to hear the question.
5, 10, 20.
What's the question?
For the owner's equity part, the original investment is $5.
That was my own money, $5. Still is in the business, yeah. That's the $5 that I had.
How did we come about the $10 for
Why?
the earning per period?
So the previous earning per period was $15 because we sold $25 worth of lemonade. The cost was 10, so we had 15. So when the parents hit us with expenses of $5, we took it out of their earnings to pay them, so it dropped down to 10.
Okay.
So that's how the 15 goes. I know how much you love this exercise, but unfortunately, I don't want to stop. I know how you usually have like 25 more to go through because you like love it. So like, please, Dean, give me more of the slides. So much. All right.
The liability, the original $10.
Let's go. You have now some of these lines don't exactly line up. But we need to know right up here for your sales. I'm going to walk through this with you. What was the total? This is an income statement, right? So we're going to do it. So you did a whole bunch of balance sheets. Now we can remember I told you balance sheet is a snapshot. This is how much money we have. These are our assets. These are our liabilities. Income statement is very fluid. It shows you a lot about the business. You cannot go by business by just looking at the balance sheet. I've owned and sold businesses. Trust me, you got to look at everything. I'm going to go through something you need to look at. So, sales. What was the number for sales? Tell me. How much did you sell in this business?
16.
$25.
$25. There is still 10 glasses of lemonade left in the refrigerator. So the total sales for your business at this moment when we write the income statement is $25. Everybody's with me on that? You sold 50 glasses. You priced it at 50 cents. That's $25. Let's talk about your inventory. What were your purchases on the inventory? How much money did you spend?
$12 plus something else.
What did you do? You
Plus
spent some money on, so this is our beginning inventory we need to work on, right? Your beginning inventory. What did it look like? You spent how much money again? 12. Your beginning inventory at a typical Walgreens is about $150,000. And you open the door, that's how much drugs is sitting. And I'm just talking about the pharmacy. I'm not talking about the cigarettes and all the junk they sell. Just pharmacy. Stick to the pharmacy part. The beginning inventory total is what number? Go ahead, tell me. No.
No, 12.
$12.
12.
You did 10 and you did 2. Lemons and sugar. Correct?
yes.
What happened to your ending inventory? What was the ending inventory?
$2
Where is that $2 exactly?
sitting.
It's in the pitcher in the refrigerator, 10 glasses. So you have a beginning inventory of 12. That's all that you bought from the grocery store. Go back to your previous slide. You did 10 and 2. Remember how you had only $3 left? So the beginning inventory is 12. The ending inventory is 2. What is the cost of goods sold? 12 minus 2. You started with 12, but you have 2. So the cost of, so you must have sold $10 worth of stuff. I'm not talking price, I'm talking about cost. Beginning inventory was $12. Everybody's with me? Ending inventory in the refrigerator is $2. The cost of goods, by goods here mean lemonade, goods means a product, that's what it doesn't mean good versus bad. Good in economics means product. The cost of goods sold has to be $10 because your beginning inventory is 12, your ending inventory in the fridge is 2. That means you must have sold, unless you secretly drank it yourself. That's cheating. The cost of goods sold is always beginning inventory minus ending inventory. If you walk into a Walgreens pharmacy and there's $150,000 of drugs sitting in the department, and you walk back in there a week later and you somehow miraculously quickly count, and there's only $50,000 worth of drugs left, what is the cost of prescription sold? $100,000. Cost of goods sold. Cost of goods sold. We're not talking price. We're not talking profit. We're just talking about cost of goods sold. I walk into your pharmacy, you told me you have $150,000 sitting on the shelf. I walk up a week later, how much is sitting on the shelf? You're my manager. You say I have $50,000 on the shelf. That means you must have sold the other 100. You follow? Cost of goods sold. In this case, your inventory started with only $12 because you kept $3 of cash. You sold what you sold. You have two left. So the cost of what you sold has to be 10. There's no other option. So that's 10 and their cost of goods sold. Okay, let's talk about gross profits. Gross profits. What did I tell you the definition of gross profit is? It's the profit before you pay your expenses and taxes. What was that number? 15 before your parents said, hey, wait a second. You owe me some money for the rentals. So your gross profit was $15. You remember I gave you your expenses. What was total expenses? $5. Two in a month. For the glasses and the rentals and advertising. So your gross profit of $15 before you pay your bill is what's indicated on your books. But you have some expenses of $5. What is the absolute net profit at the end of day one? $10. You just made $10. So the income statement shows you your gross profit and your net profit. The balance sheet never shows you that. The balance sheet only shows you these are your assets. This is what's in the fridge. This is what's in the bank. I have no idea how much money this company
net profit.
If Walgreens shows you
10.
balance sheet, give you a lot of information, but it doesn't say what the income is. Here, you just show that you had a gross profit of 15, expenses of 5, for a net profit of 10. How are you feeling so far?
25.
I told you I promised you. I'll be finished by 5 Yes. Alright. Everybody's with me? If you still don't get it, come talk to me later tomorrow next day. Yeah, go.
Did you say what the total available for sale was?
There's $12 available for sale, but you can sell them. Your beginning inventory, $150,000 at Walgreens is available for sale, but you need a prescription.
The beginning sale was 25.
It was hanging there so far? I know how much you love this stuff.
Yeah, but the sales, we started with the sales we says is $25.
Sales were 50 glasses sold at 50 cents a piece at $25.
$25. Now, we now says the beginning inventory was $12.
Correct. Beginning inventory, that's all you spend. That's all. When you went to the grocery store,
Yes.
you only spend $12 of your 50. Yeah.
Correct. Now, when we balanced the whole thing, we now came, we said, okay, cost of goods sold was $10,
Correct.
and our gross profit was $15.
Because you had $5
Five.
of expenses, right?
Okay, because we have $5 of expenses.
Remember, you're
And
not, in an income statement, you're not balancing anything. You're just going through your sales and your expenses.
oh, okay.
There's nothing to be balanced here in the
Oh,
income statement. In a balance sheet, that's why it's named balance sheet. Everything balances up. Assets balance up, equities and liabilities, but not in an income statement. Okay.
So
Let me give you some
finally,
definitions.
it is this one.
You need to keep two sets of books, as the slide says. You can have internal bookkeeping. You can have external bookkeeping. They can vary in detail, but at the end of the day, they need to be the same. So external bookkeeping, we usually do it for tax purposes. Internal may be more detailed, so on and so forth. What I need to concentrate on, and I guarantee you I'm going to ask you this on the exam, is the definition of a fiscal year. You see right at the bottom? What is a fiscal year? Anybody?
What is the amount of money spent for the company within the 12-month period within that year?
Exactly. All your financial transactions in 1 year is your fiscal year. TSU starts September 1st, ends August 31st. You can start January 1st, then December 31st. The year doesn't, when you start and stuff doesn't matter, but it has to be a year by definition, fiscal year. Walmart Corporation usually starts April 1st. They don't do calendar. What do they do calendar?
Government doesn't do calendar either.
Anybody else? Anybody give me a guess?
After taxes, after tax season.
No, the reason they don't do calendar years because in December, Walmart is really busy. Because it's Christmas and sales and all that. So they want to do their numbers when they're not so very busy, right? Because you can pick any date. Taxes has nothing to do with fiscal. I'm glad you asked that. Taxes is IRS is going to come to you and says, this is how you pay your taxes. Quarterly, whatever, and you pay those separate. Your fiscal year is start January 1st, start April 1st, TSU start September 1st. Your taxes, business taxes, is when IRS tells you they are due. You follow me? And then you just enter this into your income statement as you move along. But so remember, it is a year. All your financial transactions are there, and you can keep separate books if you wish to, but of course you can't cheat. There are all sorts of accounting rules as to how do you do this. How do you value something? How do you discount something? A lot of times you, like for example, back to United Airlines. United Airlines actually doesn't own its 750 planes. They lease them from Boeing. So when you lease a plane, you do all sorts of depreciations and all sorts of games you play. Who sets up the rules? FASB, Financial Accounting Standards Board. You're almost guaranteed to have a question on the exam. Who sets up the financial standards? FASB does. There's a bunch of old economics professors and this and that over there, I don't know, Maine or New Hampshire or something, that's what they do. Publicly traded companies have to follow them, they don't have a choice. Because SEC, Securities and Exchange Commission, recognized that's a government agency. SEC says, Mr. United Airlines, you're a public company, you have to follow FASB. If FASB says, this is how you depreciate your building, or this is how you depreciate your plane, or whatever it is, you have to follow the rules. You do not have an option. SEC will come back. And they publish, it's very convoluted, hundreds of pages of how you do your financial reporting, just like your business, your little lemonade business, right? However, if some of you open a pharmacy store, as long as it's not public, you don't care about FASB. So FASB is only because you do not have to follow them, right? We talked about taxes already. Taxes has nothing to do with how you record your numbers. Based on how much money you make, what the value of your business, IRS is going to come after start a company, they start actually collecting taxes even before you have an income. You have to pay some taxes, and then you can show that, okay, you lost money, you made money, so on and so forth. Some of you may be company owners already, some of you may be familiar with LLCs, so on and so forth. So, questions here?
What do you mean when you said if the pharmacy business is not public?
If you own your store, you don't have to follow the FASB rules. You can do your numbers however you want. Of course, you usually have an accountant that tells you how you do your numbers. But FASB, which is the standard setting body of how you do accounting in the United States, is only if you sell shares in the New York Stock Exchange, if you're a public company. If 4 of us buy a pharmacy together, you don't have to worry about that. But usually you have an accountant. None of you are going to be accountants. All of you are going to be pharmacists. So this is just a introductory lecture. I'm not going deep on any of these, so that you have a sense of when your accountant says we've got to do this and that. Like, oh, okay, I remember Didi talked about that about a group guys. We're good so far? Everybody follows me, right? Don't worry, we finished right at 29. Alright, where are we? There are different types of reports that people, publicly traded companies have to do. Annual reports is called 10K. I don't think I'm going to ask you to memorize what is an 8K, what is a 10Q, quarterly financial reports. This is mergers and acquisitions. If you merge with another company or if you buy another company, then you issue this thing called 8K. Again, this is part of FASB. As to, okay, now you got to show we went and bought another company or we merged. You know, TSU merged with another university, then they're going to have to issue financially an 8K saying, okay, how do we manage our assets? On the balance sheet, because we have assets and the other school has assets, so now you have to issue reports. So again, just for you to be familiar, remember, TSU is publicly owned, right? Keep that in mind, it's not a private place. All right, I'm going to change topics now and talk about something completely different. And that is what we call financial ratios. Again, if the book is available to you electronically, go back and read the chapter in the book that I talked about earlier. But what do we do? And I may ask you questions on this one as well, and I'm going to show you a couple of examples in a minute. But first, I want to tell you, financial ratios is something you use to do what? You compare one organization to the industry. You compare Walgreens to all the chain pharmacies. That's an example. We're going to do financial ratios to compare Walgreens with everybody else. 2 or more organizations to each other in the same industry. We're going to use financial ratios. You're going to see examples in a minute. You're going to compare Walgreens profitability to CVS profitability. 2 organizations in the same industry, 1 to the entire industry. Pretty straightforward, right? Differences over time. Financial ratios will show you how Walgreens is doing in January when it's cold versus June when it's hot, right? Differences over time is when financial ratios are used. And sometimes 2 units of the same organization, meaning I'm going to look at the financial ratios of Walgreens that is over here by TSU versus the Walgreens that is over there by Rice University, just to see how the 2 of them compare. So these are the uses. Without you knowing what they are, this is what we use them for. Very straightforward. Questions on that? Till I show you some actually in a second. We're good? All right. There are, of course, limitations. You got to make sure you have clean data. You got to make sure that you have some kind of a reference point. And also, when you buy or sell a business or do these comparisons, you can't just look at one single ratio. You got to look at a whole bunch of ratios. So what are these ratios I'm talking about, now that you know the uses? The ratios come in different types. There's profitability ratios, liquidity ratios, and turnover ratios. 3 times. Let me ask you that question. Name the different types of ratios. Profitability, I can pick a ratio to see how profitable you are. How liquid you are, that means how much cash you have. Liquidity also means cash. 95% of the time when a business goes bankrupt, it's because they don't have enough cash. Almost 95% of the time, they can't pay their bills. They go bankrupt. So, ratios are to measure profitability, how much cash we have, and how fast you turn over your inventory. Remember, you did pretty well because you had an inventory of 60 glasses of lemonade, and on day one you sold 50. That's a pretty good solid turnover. If you had only sold 10, maybe your ratio is not that high. We're okay here, right? Straightforward? All right. Let's give you some examples. Gross margin ratio is a PR, meaning it's a profitability ratio. I use it to see how profitable you are. I'm going to take all of your sales. How much sales did you have? $25. Your cost of goods sold was how much? 10 divided by 25. So 25 minus 10 over 25. That's your ratio. So, take all the sales of Walgreens in millions of dollars, divide that by the minus cost of goods sold, what did it cost them, of the stuff that they sold, divided by sales, give you a number. You want that number to be between 20 to 50%. The reason is, I have the reason at the bottom. Indicates money available for expenses. Because remember, gross margin is coming from cost of goods sold, is gross profit. You haven't paid the bills yet. So you want to have a large number. Because from the gross profit is when you actually pay all the bills, from your salaries to your technicians to so on and so forth. Here's another one. Profitability ratio. Net profit. Net profit is your net income after you paid all your expenses divided by your total sales. You remember your net income? How much was your net income? $10? $10 divided by 25. Of course, net income equals after-tax income because you have to pay your taxes or they shut you down. And you want to be 2 to 4%. That's the money that you completely set aside. It's your net profit. You paid all the bills. You paid your big salary as an independent owner of a pharmacy. And now, whatever is that? Again, you want that ratio to be 2 to 4. Now, return on investment, you've also heard the term return on assets. There's these two terms sometimes you hear interchangeably. You've heard the term ROI, return on investment. What's the return on my investment? Or return on assets. You either take, ROI is also known as return on equity, that's another name, don't worry about that. Net income over owner's equity. Owner's equity is the money you put in. What is my net income over the amount of money I invested in this business? You want 15 to 30. Same with the other one. Net income over ROA's return on assets. What is my net income over the total value of assets, which is cash, building, delivery cars, all of that? 15 to 30%. Right here. Net income over owner's equity. Owner's equity is what? Your money. It's not your liability. It's not the money you borrow. It's the money you put in. Remember that part? Owner's equity. 15 to 30. The above two, I know some of you, the screen is really weird. Some of you may not see the bottom. The above two are used to measure managers' competency. This is a profitability ratio. Why am I using it to see if my manager is competent? Why? I own a pharmacy. I get my profitability ratios every year. I had a net income of $200,000. What was my owner's equity? Was whatever number. I was at 30%, 15%, whatever. Why did I write that statement at the bottom of the slide? Why do you use ROI measure somebody's competency? You want to leave at 4:20? We need an answer. You can guess something.
To make sure they're within that range.
Say that again.
To make sure that they're within that range.
To make sure they are within this range. So, for my pharmacy, I hired this one young lady over here. For a year, she manages my pharmacy. I look at my net income versus how much, $2 million I put in the business. I get 15. This other young lady comes and says, are you kidding? Hire me as a manager. I'll do such a better job. I'm going to change this from 15 to 25. I'm going to fire her. Hire her. Because she promises to increase my ROI. The CEO of Disney makes $36 million cash. That's his salary. That's $3 million a month. What does he do for that money? How do you what he works 160 hours a week? Or what does he do? How do you determine $36 million salary for one person? And this is cash. This is not the private planes and food and everything else. How do you figure that out? How do you pay $36 million? This is your answer. Because he comes to Disney board of directors and says, hey, if you hire me as a CEO, I will increase this number. Were you at 15 last year? I'm going to jack it up to 25. But I want $36 million salary. That's how they make those money. They don't say, I'm sorry, you pay $50 an hour? Okay, I'm your man. The ball grades over here. That's not how it works. So this ROI, to measure somebody's salary, that's when you use the equation. You say, hey, if I work for you, I am going to, this is a very significant number. In a large company, if you increase this by 2%, like if you're United Healthcare, the dude who was at United Healthcare who was fired because he did something stupid, he was making, this is a healthcare agency, you're going to be in it soon enough. He made $200 million cash compensation a year. Because he told the board that within 5 years, I'm going to take your 15 and I'm going to make it 30. Boards are not stupid. They did it. I'm like, wow. So instead of $1 billion, we're going to make 5. Net income. Oh, you only want $200 million? Shake hands. You follow me? So this is why that last sentence is in there. Yes, it is a profitability ratio, but the way these guys make the kind of money they make is they go to these boards and they convince them that I can change your ROI because of my leadership abilities, whatever, my marketing abilities, I can bring new customers to you, or whatever the details are. Let me quickly go through, I'm going to skip over this one. The earnings per share is really the same, it's another ROI. And and again, today or tomorrow we'll post the lecture notes for you. So, liquidity ratio is how much cash you have, is how much assets you have versus how much liabilities. Remember, 95% of the businesses that go out of business is because they don't have enough cash. So you always want to make sure that your assets are at least a ratio of 2, double the size of how much money you owe. Okay? So the ratio of 2 is conservative. If you're less than 2, you may get into trouble. Last ratio we're going to talk about, I believe, is turnover. Remember your cost of goods sold? Yes. Average inventory. So your cost of goods sold at Walgreens store number whatever is $1.2 million. That's the cost of goods sold. In a given fiscal year, they sold $1.2 million of stuff. I go to measure the inventory, calculate it, it's $100,000. So 1.2 million, average inventory is 100. What's my ratio? What's 1.2 million divided by 100,000? 2 more seconds. I got $1.2 million of the stuff that I sold, but the average inventory in the store is 100,000. What is that? What is that ratio?
12?
12.
Yeah.
12. 100,000 divided multiplied by 12 is 1.2. That means every month they turn over $100,000 worth of stuff. That's what turnover ratio means. I sold 1.2 million. I have $100,000 at any given time on the shelf. My turnover ratio is 12. That means every single month I turn over the entire inventory. The inventory is 100,000. That's why the term turnover. It's $100,000 on the shelves, but every month I turn it over to fresh medications back on the shelf. You follow me on this one? Very straightforward. There's nothing tricky about this. Okay. If this is too low, it says if it's too low, you have too much inventory. If this is 1.2 million, but this is 200,000, now your inventory turnover ratio is 6 instead of 12, right? 1.2 over 200,000. Too low. You got too much money sitting on the shelf. For a typical pharmacy, it used to be about 10 to 12. So if your turnover ratio is 1, again, you sold 1.2, but you're keeping $200,000 around, you're not doing what you're supposed to be doing. You're not good. It's too low. Your ROI is going to go down. Your return on investment is going to go down for sure because you're keeping too much inventory on hand. You're not selling it fast enough. 12 is about the right number. What if it's too high? I have 1.2 million sold, right? But my typical inventory is only $50,000. So now what's my ratio?
15 or 50?
24. Remember? If it's 1.2 million, if it is 100,000, it's 12. That's about right. But if this number is 50,000, your ratio doubles to 24. That ratio now is too high. I don't keep too many drugs on hand because I want to have a very high ratio. I want to turn it over really quickly. What's the problem with that? There's a huge problem with that. When your turnover ratio is too high, right? You're selling them too fast. What's the problem you're going to run into? It says it results in lower sales. How's that possible?
Because of supply, you don't have enough supply.
You don't have enough supply. You don't have the product. Every time I go to CVS to pick up something for my wife, oh, we don't have it. What do you mean you don't have it? You don't have supply? How's that possible? You're keeping it too low. So the customer ends up going someplace else that could hurt you. How are we doing with time? Oh, we've got 12 minutes. Plenty of time. All right, this is in the book, and it's a typical balance sheet. That's what you just worked on. Of course, assets could be divided into current assets and non-current assets. Non-current assets are things like buildings and equipment. Current that you played with your example is more like cash, accounts receivable, so on and so forth. So this is just an example of showing you, before we went to operations, we had over here total assets. You notice here is 600,000. And we put $300,000 of our own money, we borrowed some money, it adds up to $600,000 on the balance sheet. Remember, your assets always add up to owner's equity plus all your liabilities that are out there. So again, we borrowed, we got free inventory. In year 2, our assets went up by $200,000, right? And we have something we didn't have before. Here you see a retained earning of 0. We have no business yet. But here we have a retained earning of 200,000. You're like, what is that? What is retained earning? The balance sheet doesn't tell you that. If you go to an income statement and you see, oh, so we also did an income statement. We had prescription sales of 2 million, we had non-prescription 2.5 million, we had total expenses, we had them all up. We had a net income of 300,000. Our net income on the income statement for this pharmacy shows $300,000. I'm going a little bit faster through this because this is not something I'm going to ask you on an exam. It's not something I want you to memorize. I just want you to be familiar with it. Sitting here, paying attention. Everybody's in the present moment, right? You're not thinking about dinner or lunch or tomorrow.
No.
I made $300,000. Right? Go back one slide. The earnings that I left in the business is 200. What happened to the other 100? See how they connected they are? So this shows you left $200,000 back in the business, retained it in the business. Okay, show me the income statement. Oh, you're making $200,000. So what's happening here? Well, what's happening is that there is another report that is called Statement of Retained Earnings that says you made $300,000. You gave $100,000 to yourself, to your partners, put $200,000 back in the business. Everything at the end of the day has to balance out. There is no way of something missing. So income statement shows 300. It is my business. Actually, my own brother in Las Vegas is a very successful pharmacy owner. So he does all sorts of things like this. So he paid himself a big bonus from the 300 and put the other 200 back in the business. Whatever that means. Buy new computers, increase the inventory, hire people, whatever that means. All right. The last thing we're going to talk about, what is this one? Okay, we decided not to talk about cash flows. Now, you moved in the next 8 minutes or so. You move completely from Walgreens and you go work in Memorial Hermann Hospital Pharmacy Department. So everything that I just told you up to this point, except the financial ratios, the rest of the stuff I showed you about Walgreens is not true at Memorial Hermann. This is what they do there. Pharmacy department expense for actual versus budget. They don't do anything that I just showed you because they're not selling anything. If you're a director of a hospital pharmacy at Harris Health or whatever, the director, the CEO comes and says, or the CFO, Chief Financial Officer, says, okay, your pharmacy department this year, we will give you a $20 million budget. That's your budget. Hire pharmacists, hire technicians, do whatever, pay for the drugs, blah, blah, blah. Because when you go to the hospital, you don't get a bill for the medications. You just get a bill for everything. Right? You break your leg, you go in there, they do surgery, whatever, they remove your appendix, you get a bill from the hospital for $10,000. So, in hospital pharmacy, these guys make no profit. What are they called?
Cost.
Cost center.
Cost.
Exactly. They're a cost center. They're costing the institution, although they make money for the institution because they treat the patients, otherwise the patient wouldn't go there. So what do? They do August of 2011. They do year-to-date. They do monthly last year. They do year-to-date last year. They do all sorts of numbers. So what do? Manager, supervisor for the month of August, that manager was, the budget to pay the manager was $37,520. That's a nice salary for a month. Right? But they actually paid him $37,916, so they have a variance of $396. Positive variance, bad. Negative variance, good. So they budgeted technician and interns, they budgeted $70,000, they ended up paying $68,000, they had a variance negative of minus $1,700, whatever. That's the life of the hospital pharmacist. If you decide to go become a hospital pharmacist, which I hope every single one of you do, because it's a beautiful job, I did it for a couple of years myself, these are the types of things you see. Budget, actual, last month. So what happened monthly last year? Oh, okay, well here are my numbers. I have my variance, I have my actual, everything is here, right? These are the types of forms that when you get to your fourth year, that'll be when? Next year.
This year.
I'm sorry, this year. In May. We have some good plans for you. You heard about the pass rate, right, last year?
The what?
The pass rate.
Pass rate,
Oh, yeah.
second highest in 10 states. So the classic 1 in 23, they don't want to be called losers. They have to hit better 85. They have to get at least 86%. The only school that was ahead of us was UT Austin. I had dinner with the dean of UT Austin. I told them, don't get too excited. I'm going to be ahead of you next year. We want to be number 1 in the state next year. So that's
Amen. Amen.
the class of 2024, that would be.
We going to the shit.
What?
We going to the shit.
You what? You're going to be the champ. You guys. Okay, for me, personally, we're gonna digress a little bit, but don't worry, I'll still get you out of here by 5 minutes. For me, any number less than 95 is unacceptable. How they do budgeted versus actual. They even do reporting on their FTEs. You know what FTE stands for, right? The full-time
employee equivalent.
Okay? So what these guys do is they do all sorts of reporting as to, I am going to, for this period of time, I'm going to budget 38 pharmacists, right? But my actual was 39 pharmacists. I had a variance of 1. These are paid FTEs for whatever the pay period was. Okay? So the financial reporting in hospital pharmacy is extremely different. There's balance sheets, there's no income statement, everything is done based on a budget. I will post this. The questions that I'm going to ask you are very straightforward. Some of them I already told you. There's some simple true false, maybe a couple of multiple choices. There's no essay. I usually ask essay questions. This course that I